Good afternoon. Welcome to Mid-Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Another down day. We are below the 24,500 mark for now. There is a wee bit of recovery from the lows of the day. Nevertheless, it's a red-looking screen. Nifty IT is the one which has been volatile, was in the green for a while and then again into the red. But mid-caps are bearing the brunt, one of the biggest losers today.
That's right. Good afternoon, Sonal. Mid-cap, small-caps bearing the brunt of the selling pressure. And today, the Nifty Metal Index as well as the PSU Banking Pack have also started falling, and that too has led to significant weakness as far as market is concerned. A lot lined up on the show, some important market as well as corporate conversations lined up as well. So let's start off with the top headlines. Market comes off the day's low. The Nifty hovers at near 24,500 levels. Sharper knock on the broader indices. Volatility mounts while IT continues to buck the trend.
War worries hit gas companies. Sources indicate Gujarat Gas has cut supply to industrial sector by 50%. Qatar declares force majeure on deliveries amid Iranian drone strikes. City flags near-term value chain risks. Sharp cuts on shares of Petronet, Gujarat Gas and GAIL.
Pressure mounts on industrials on account of exposure to West Asia. Nifty major Larsen & Toubro tanks 10% in just 2 trading sessions. Siemens, ABB, India, Cummins all down and out.
Global risk-off sentiment dents metals and over 4% knock on the Nifty Metal Index. Top drag on the Nifty, Tata Steel. Significant pressure across SAIL, NMDC, Hindustan Copper.
Amid a broader market sell-off, sugar stocks like Balrampur Chini, Dhampur Sugar and Praj Industries are gaining as rising oil prices due to the West Asia tensions boost ethanol demand expectations.
And the big story continues to be tensions that we're seeing in West Asia. They continue to escalate as the war enters its 5th day. Israeli and US forces continue to pound targets across Iran. CNBC's Middle East correspondent Dan Murphy joins us with the latest update on the ongoing crisis.
The drone strike on the US consulate in Dubai marks another dramatic development in the Iran war, which is now well into its 4th day. Vision shows a fireball shooting into the sky above the consulate, which is located only a short drive away from the financial center and downtown Dubai. The Dubai media office confirmed the fire was quickly put out and there were no injuries. The United Arab Emirates also says it has not changed its defensive posture despite a wave of Iranian attacks across the country. Officials say the UAE has now faced more than 1,000 attacks since the start of the escalation. A total, they say, exceeds the number of strikes targeting all other countries combined. Meanwhile, US officials say the strikes on Iran have already surpassed the scale of the 2003 shock and awe campaign that opened the Iraq War. A senior US commander saying the first 24 hours of this operation were nearly double the intensity of the initial assault in Iraq. US officials confirmed today 2,000 targets have been hit and 17 Iranian naval vessels, including a submarine, have been destroyed. But the major focus for the international markets is on the Strait of Hormuz, where President Donald Trump says the US Navy could begin escorting commercial tankers if necessary after threats from Iran to set fire to any ship that attempts to make the crossing. In a post on Truth Social, the president said the United States would ensure what he called the free flow of energy to the world, and said Washington could also provide political risk insurance to support maritime trade moving through the Gulf. We've already seen major oil and gas firms looking for alternatives, including Saudi Arabia's Aramco, which is rerouting more crude exports through the Red Sea port of Yanbu, according to reports. Roughly 20% of the world's oil supply passes through the strait, and energy prices have been surging as traders weigh the risk of a prolonged disruption to global oil supply. For now, the situation remains extremely fluid as military operations expand across several fronts in the Middle East.
Well, it's a very good time to welcome Prashant Khemka, founder of White Oak Capital Group. Thank you so much, Mr. Khemka, for joining us. Well, just as we were celebrating a trade deal with the United States, we are now grappling with geopolitical tensions at the current market junction. How are you looking at equities as an asset class? And are you also worried about what this particular war could lead as far as commodity prices are concerned as well?
Thank you, Vivek. Certainly, any war, particularly a war of this magnitude, would be worrying to to anyone, including as an individual or as a human, and certainly as a market participant as well. But stepping back, if you see over the last many decades, the first war that I remember of size would be in the early 90s, right? Where the Kuwait related, Iraq's invasion of Kuwait and the war that ensued following that. And there have been multiple wars since then. Now, so far, these wars have been contained, either both in their scale, certainly in their scale, though obviously Russia, Ukraine, you've seen, has dragged on for much longer. So let's say we don't know, we are not war experts, we don't know how long this would last, whether it intensifies, whether it resolves itself very quickly, but the future of the market would be a function in the near term of these outcomes. So if the war were to resolve soon, right, whenever you're in the midst of it, it never seems like it would resolve soon. But if it were to resolve soon, then we'll see market bounce back. If it were to go into a tailspin and get out of control beyond what the level of intensity is right now, then there could be further impact on the market. The market has pulled back about 4%. Indian market I'm talking about. Globally, markets have been to varying degrees. Obviously, South Korea is down 20%, but it's not just related to war. It's just a function of also what it had done, over the last 15 months or so. So it can also end up being a long-drawn affair, like Russia-Ukraine. Now we no longer talk about Russia-Ukraine war. Nobody talks about Russia-Ukraine war anymore. Yeah. So if it does turn out to be a long-drawn affair and remains contained to a certain level, people would move forward, move on, and then the markets would, stop. I won't say start ignoring it, but then factor it in and whatever limited impact it has on corporate earnings and so on and so forth. So we'll have to see how it evolves, but we at White Oak don't take any particular such call. We remain fully invested, and so are we today. There's a tail risk, obviously, with all these things, but market is capturing that probability at this time. But obviously, if it turns into event, then it would be a problem.
Prashant, in that case, you indicated there could be two outcomes, and the hope is that the outcome is on the positive side. But if it does continue the way it is right now, the way Russia-Ukraine war is happening, do you think before bouncing back, there could be a sharper cut? We were speaking to some market experts in the morning as well. They indicated there could be a 10 to 15% cut. Do you have any indication, or do you expect something like this to happen to Indian markets? And is India at a bigger risk versus the other emerging markets because of whatever is happening geopolitically?
I think it's impossible to say. Impossible at this stage to say, because first of all, we don't know what's going to happen in war, whether it intensifies, whether it gets worse before it gets better, and so on and so forth. Even if we knew precisely what's going to happen, then it still remains unclear what the market reaction would be to that. So to conjecture market will be down 10, 15, 20% or any percent, or to bounce back tomorrow, I think it is a lot of conjecturing and would not be on the basis of any sound analysis or insight, I would say.
Right.
But in terms of the comparison with other emerging markets, considering that we are a big importer of oil, gas, rupee right now is at a record low. Between the EM's basket, do you think India is at a greater risk?
I don't think India is at a greater risk. Obviously, if you look at countries around the world, many of the countries are actually down a lot more than India is down for a variety of reasons. See, while a lot of our oil imports are dependent on the region, and if it gets completely blocked, how much of it can be substituted? See, oil is a global commodity. Just because we are in the proximity of the Middle East, it doesn't mean that we can't get oil from elsewhere. The cost of getting oil from elsewhere might be a few dollars more, a few percentages more. It's a global commodity, just like steel, aluminum, there's a global price. The global price would be higher if a certain amount of output is out of market for a while. But at that price, we should be able to procure it. So think of it as currently the oil price as it's showing is 83.5 bucks. At 83.5 bucks to somewhere between 83.5 to say 5% higher, we should be able to procure as much oil as we want. I'm not an oil expert either, but that's what global commodities are. You add on the transportation charges and 5 to 10% higher from here, we should be able to procure the same Brent oil that is priced at 83.5 right now.
Take that point on board, Mr. Khemka. The other question which we want to ask you is, it's now quite clear that countries across the globe will have to go ahead and ramp up defense spending quite significantly. Do you see an opportunity, number one, both for Indian exports, from Indian defense companies and within the Indian domestic space as well? Is that one particular sector where you see incremental flows go into?
See, I agree that for a minute, keep the stocks aside. But if you take the real world and the outlook for the defense companies, absolutely, I think the events of the last several years, I would say not just this war, but last 5 to 7 years, if you see the events, how they've played out, hate to say it, but bodes very well for defense companies. Everywhere around the world, defense spending is going to sustain, is going to, I think, rightly so, deserves to be ramped up and would stay at sustained high levels for a long time to come. Long time to come, certainly I think beyond a decade. Because see, not just the wars that have happened, like in the Middle East, the Gaza war, and then the Russia-Ukraine war, but the whole thing where Trump has, de facto basically asked NATO, European nations to ramp up their contribution to NATO and ramp up their defense spending, and all the European nations have. They were for decades, falling back on the security provided by the US and had let their defense spending come way below what it ought to be given their neighborhood. And with the Trump administration asking them to jack that up, that is a huge source of global defense spending that's going to be there for many years, not just many years, for decades to come. And on top of that, what you've seen in other parts of the world, there is going to be a heightened level of insecurity and increased spending at every country's level, and percentage of GDP spent on defense ought to go up globally.
Okay. Prashant, quickly, if you can tell us before we let you go, had this war not happened, and considering that we did have a deal with the US on tariffs and earnings growth, which did come back somewhat in Q3, what is the earnings growth you were projecting, notwithstanding whatever's happening globally? And do you think the fundamentals domestically were strong enough to see a recovery going forward?
Certainly, as they say, the proverbial green shoots, the omnipresent green shoots were present in a lot of corporate commentary. Putting all this together, before this war started, we were expecting a recovery in earnings growth to low double digits for the year fiscal 27, which is not much higher than the nominal GDP growth rate, and which tends to be our default expectation for earnings growth from the Indian market, and particularly so given where corporate profitability is right now, which is neither suppressed nor hyper-normal, super-normal. So low double-digit earnings growth seemed fine, and even after the war, I don't think, at least as of now, there is a material change to that expectation.
All right. Thank you so much, Prashant, for joining in today with your thoughts on the markets and the outlook going forward. It's uncertain right now, but of course, this is what the market looks like right now. DLF is in focus because there is a CBI probe which is directed by the Supreme Court for irregularities at Primus DLF Garden City project, because they say it is regarding home buyers who did not get the delivery of the project in time. They missed the deadline, and that is the reason why they say there has to be a CBI probe. We'll get you more details on this one, but for now, the stock is on our radar. We'll slip into a short break. When we come back, we'll connect with Manoj Erwadia, who's the president of Morbi Ceramic Association. We'll decode the impact on the gas supplies cut which has happened from Gujarat Gas to the industrial space. Stay tuned for that conversation. Welcome back. You're still tuned into Midcap Radar on CNBC TV 18. The markets continue to be lower. We are at that 24,450 mark. Some recovery from the lows of the day, but still the broader picture remains very weak. Midcaps down 2.5%. We do have the metals index, which is lower in trade as well, down 4% as we speak. Realty is giving it some company. That is the other mover. That index is down 30% from its 52-week high as well, as that continues to be under pressure. PSU banking index is also down. But, you know, in a market like this, there are few stocks which are bucking the trend. Sugar names, for instance, most of them are higher in trade, the likes of Dwarikesh Sugar. We do have Sri Renuka Sugars. Some of these names are higher in trade on the back of higher crude prices, which tends to be positive for some of these companies because of higher ethanol prices. We do have Chennai Petro, which is high by 6%. Some of these defense names that we've been talking about, Paras Defense is up 5.5%. Urban Company also is up 2%. Swiggy is up 2%. So there are some outliers in the market today. So we'll do one thing. We'll slip into a short break. When we come back, we'll discuss more about markets and some themes that we have been tracking. Welcome back. It's time to get a conversation on the gas supply cuts to the industrial space. Let's welcome Manoj Erwadia, who's the president of Morbi Ceramic Association. Mr. Manoj, good afternoon. Thank you so much for joining in.
Good afternoon.
Can you confirm whether Gujarat Gas has gone ahead and cut gas supplies by 50%? And if yes, what are you doing to basically balance the gas supplies now?
Right now, yes, Gujarat Gas cutting the 50% of the gas supply, and the propane and LNG will be completely stop the supply. And right now we are facing the problem, and we have to completely shut down our factory.
So you have shut down
Due
your
to the
factories
war,
completely?
Yeah, we have to shut down. We have to stop our production.
Okay. Can you now give us a sense, or if you could give us a ballpark figure of the kind of financial hit that ceramic players will have to take, given the fact that at this point of time we are uncertain as to how long these particular cuts will last? So what will be the current prevalent prices of gas in case you want to procure it? And number two, when do you expect things to revive once again?
See, we cannot think anything right now because this is the war situation, and until the war situation is stable, the gas will be not comes to the for industrial purpose. So once the gas started, and we can start our factory, but it will be cost is very much higher. Right now, we seen the new almost 50% gas price is increased. So it will be very difficult for us and very challenging that we can run our factory with these higher prices.
So 50% gas prices are higher, but that is natural gas. What about propane? Propane and Gujarat Gas's gas, that has been a competition so far, right? Are you not getting even propane?
No, actually, you see, in our industry, we have the two type of the gas suppliers. One is the propane and LNG, and other option is the Gujarat gas, CNG, natural gas. So our industry is almost 60 to 70% user are using the propane and LNG gas, and the rest of the 30% using the Gujarat gas. But right now, from the yesterday, we received the message from the government, and we received the message all from the propane supplier. Almost propane supply is suddenly stopped, properly stopped. So within 2 days, we run the factory, and Gujarat Gas having also problem, and Gujarat Gas also cutting the 50% of the gas. So I think so maximum 10 to 15 days we can run our factory with Gujarat Gas supply.
Okay. Mr. Manoj, the other question we want to ask you is, what are the conversations that you're having with the government? Is the West Asia route the only route you have as far as supply of input materials is concerned, or are you now looking at alternative sources as well? And what kind of hit will customers take on account of these particular disruptions?
See, this I don't have any answer for that your question, because this is the war situation, and in war situation we cannot think that we accept this government and they are trying the other source from the other way, but still we don't have any such kind of the news.
We totally understand it's very uncertain, so many companies will also not be able to give you any answers. But Mr. Manoj, before we wrap, if you can give us the size of the entire industry, the ceramic industry, what kind of exports do you have? What kind of domestic revenues do you have?
Right now, our industry is around 60 to 7,000 crore in yearly, our total turnover capacity. And from them, we are exporting around the 20,000 crore export and 50,000 crore is the domestic market. So definitely this war is effective in the war, majorly in the export, and main area is our Middle East countries. Middle East, we have around the 5,000 crore export in per yearly. So right now the export will be stopped completely, and other part of the export way also going from the Gulf Sea. So they are also affected from the export. And domestic market, because of the now gas shortage, and when if we have the availability of the gas, so I don't think so gas price it will be same as before. Maybe gas price also going to higher and we cannot survive. So we don't have any way. Either we have to increase our product price, either we have to shut our factory.
Well, thank you so much, Mr. Manoj, for joining us, giving us a sense of the current situation as far as Morabic Ceramic Association is concerned as well. And we hope that things do get resolved quite soon. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.